any surprise that gold and silver are continuing to surge this morning? And to be honest, I could see gold easily at 5,000 by the end of the year. Yes, that's how serious things are. And why do I say that? Well, because even investment banks like Goldman Sachs said that if Trump kept pushing the Fed and kept infringing on its independence, so to speak, that gold could easily go to 5,000.
Gold is now the anti-fragile asset to own. Do you know why gold is the anti-fragile asset to own? Because it's money. If Morgan Stanley understood that, they would have had some gold before it reached all-time highs and above. How can you reach above all-time highs? Whatever. But now they're jumping in. You'll see other investment banks jump in. So let's take a look at how much money we're talking about if Morgan Stanley is going to shift its 60-40 portfolio, where its clients are now, to a 60-20-20.
Gold just crossed the line from hedge to headline, and Wall Street is finally treating it like money again. Rafi Farber pointed out something remarkable unfolding in the financial establishment. Morgan Stanley, one of the world's biggest investment banks, has quietly abandoned the sacred 60-40 portfolio model that has defined institutional investing for decades. The old strategy 60% stocks and 40% bonds was built on the belief that when one falls, the other rises. But as Rafi explained, that logic collapses in stagflation, when both stocks and bonds decline together, because the real problem isn't the assets, it's the currency they're priced in. Rafi Farber highlighted that Morgan Stanley's chief investment officer, Mike Wilson, now openly recommends a 60/20/20 allocation, 60% stocks, 20% bonds, and 20% gold. That means half of the traditional bond exposure is being replaced with gold, not as an emergency hedge, but as a strategic core holding. And as Rafi noted, that capital must come from somewhere, which means it's being pulled straight out of the bond market, pushing interest rates higher. But Rafi warned that this is only the opening move. Institutions are just repositioning, not panicking yet. True capitulation into precious metals won't happen until gold and silver clearly outperform equities. When that happens, the shift won't be about diversification. It will be about escape. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue bringing you sharp insights and expert perspectives on gold, silver, and the forces reshaping the financial landscape. Thanks for watching.
Morgan Stanley, whose chief investment officer, is now recommending, as opposed to the 60-40 portfolio where you have 60% stocks, most of which are the Magnificent Seven and the bubbles of the day right now, AI, 60% stocks and 40% bonds, on the theory that when stocks go up, bonds go down, and when stocks go down, bonds go up, or bonds always go up, so they offset each other, which doesn't take into account the possibility of stagflation, which means that stocks go down and bonds go down and gold goes up. But anyway, he has now changed from a 60-40 portfolio to a 60-20-20, where you're 60% stocks, 20% bonds, and 20% gold. So the other 20% that used to be in bonds is now in gold, according to Chief Investment Officer of Morgan Stanley, some guy named Wilson. So that means that the money that is going into gold is coming from bonds, which means that interest rates will go higher as investment banks follow each other with these recommendations, because they are all a bunch of lemmings and they follow each other. My point is that they follow each other because that's how the business is. So Morgan Stanley is the first big investment bank to come out with this publicly. It's going to be followed by many others. So let's take a look at this article and then take a look at how much money would be going into gold if this CIO of Morgan Stanley is to be taken seriously. We have your article from Reuters. Morgan Stanley CIO favors 60-20-20 portfolio strategy with gold as inflation hedge. This is by Mehnaz Yasmin, who I don't know what country he's from or she's from or whatever, but you have here these gold bars with those serial numbers. Isn't that beautiful? It's about gold. So here we're going to read the first three paragraphs and get the point. September 16th, Reuters. A 60-20-20 portfolio strategy that includes 20% gold is a more resilient inflation hedge at a time when U.S. equities are offering historically low upside over treasuries and investors are demanding higher yields for long-term bonds, Morgan Stanley Chief Investment Officer Mike said on Tuesday. A 60-40 portfolio, which typically has 60% of its holdings in stocks and the remaining 40% in fixed income, which means debt, counts on moves in the two asset classes to offset one another, meaning one goes up, the other goes down. That's how it normally is, unless there's stagflation and the currency is imploding, which is probably what's happening now, which is why the CIO of Morgan Stanley is recommending 20% gold, because he sees the currency in collapse. He's not going to say that, but that's what he sees. Anyway, continuing with the sentence, with stocks strengthening amid economic optimism and bonds rising during turbulent times, that's how it's supposed to be with the 60-40, but it's not anymore because the currency is in collapse. Wilson, however, favors a 60% allocation to equities and 20% each to fixed income and gold. Within bond markets, the prominent Wall Street bear prefers shorter term duration treasuries of 5 years over the 10-year note to capture rolling returns along the yield curve. Gold is now the anti-fragile asset to own. Do you know why gold is the anti-fragile asset to own? Because it's money. If Morgan Stanley understood that, they would have had some gold before it reached all-time highs and above. How can you reach above all-time highs? Whatever. But now they're jumping in. You'll see other investment banks jump in. So let's take a look at how much money we're talking about if Morgan Stanley is going to shift its 60-40 portfolio, where its clients are now, to a 60-20-20. How much dollars, how many dollars is that? And before you tell me, well, they probably already did this or else they wouldn't be announcing it. Yeah, let's assume that's true. That still means that other investment banks that are bigger than Morgan Stanley are going to follow eventually, and probably pretty damn soon. But let's look at these numbers. Morgan Stanley's annual report 2024, and it says here, look at this, investment management, AUM. That means assets under management, how many dollars worth of assets are under its management in these 60-40 portfolios that will end up being 60-20-20 portfolios. That is $1.666 trillion, because it says 1,666, and you see here, here's the parentheses, billion, so $1,666 billion, 20% of that. Yeah, okay, so $333 billion. Let's assume that all went into gold already. So we have other banks that are bigger, like JP Morgan and Bank of New York Mellon. I don't think that's bigger than Morgan Stanley, but whatever. You have big banks. And obviously, all other banks in the world are going to follow Morgan Stanley eventually. The 60-40 portfolio is going to become the 60-20-20 portfolio, and all the investment banks are going to invest, if they haven't yet, 20% into gold. And as they realize that stocks and bonds are both crashing, they will plow more and more dollars into the gold market, which is why gold is at all-time highs. It's not the only reason why, but you could ask me the question, is it time to sell? Is silver, and gold, are they really outperforming the S&P 500 now? No, this is just the beginning. This is the silver to S&P 500 ratio. You can see here that from 2000 to 2011, silver did handily outperform the S&P 500, but since 2011, when we last hit $50, the S&P 500 has vastly outperformed silver, also gold, and we haven't even broken through a trend line, which would start at 2016 over here, tagged it in 2020, and it has not been hit yet. So this has been the rally from whatever this tiny number is to whatever this tiny number is, 0.007. And we have shown you this chart in other videos, and also I cover it on my Substack on endgameinvestor.substack.com, where the all-time high in silver relative to the S&P was like something like 0.44. And here, if you take that into account, this number of about 0.04 is barely registered on the graph. But here, really, this is really nothing. This is nothing. Because if you invested in the S&P 500 and only just bought the SP 500 ETF month after month, reinvesting dividends, you would have vastly outperformed silver since 2011, even since 2008, and even since I think you would have tied for about 2006, whether you invested in the SP 500 or silver. You probably would have outdone silver with the SP 500 because S&P 500 will give you dividends, whereas silver won't, unless you have a silver and gold account with Monetary Metals, which you can find a link in the description down below. But anyway, the point is The rally has barely started yet, and people won't panic out of their stocks and panic into gold and silver until they realize that gold and silver are vastly outperforming the S&P 500. We will get there. We might get there sooner than you think. But right now, this is not a panic. This is just the investment banks that are starting to look in the other direction and starting to think that maybe gold is an inflation hedge. And the secret really is gold is not an inflation hedge. It's simply money that isn't inflated, because money can't be inflated. Derivatives of money can be inflated by inflating their number over the money supply, which is the gold and silver supply. But gold is not an inflation hedge. It's just money. That's it. So what are we going to see? We're going to see interest rates go up as investment banks sell some of their debt, some of their treasury debt, and buy gold with the proceeds. And that is why interest rates are going to head up, and that's going to affect stocks negatively. And as their stock and bond portfolios continue to underperform the metals and the money itself, they will continue to sell their bonds and their stocks and pile into gold and silver over time. How much time? Not that much time. This is the beginning of the end as the mainstream recognizes the hole that it is in, as the gold and silver bugs wave to them from the ground level and encourage them to keep digging to get themselves.
Mario Innecco made it clear that gold's surge isn't random hype, it's a stress signal from the global financial system. When even major Wall Street institutions are whispering about $5,000 gold, something is seriously cracking beneath the surface. Mario said outright that he wouldn't be surprised to see gold reach that level before year-end. And to anyone calling that unrealistic, he reminded them of history. In late 1979, gold more than doubled in just 2 months, rocketing from around $400 to nearly $900 by early 1980. By comparison, jumping from current prices to $5,000 would be a smaller move than what happened back then. Silver, meanwhile, is acting like a coiled spring. It smashed through $47 overnight with barely any resistance, just as Mario predicted once it cleared the $44.20 level. Now he's openly eyeing $50 possibly within days. If silver breaks that mark, it'll be the third major attempt in 45 years to take out the $50 ceiling, and Mario believes this could be the one that finally blows the lid off. With gold already touching $3,818 and climbing, both metals are delivering the same message. Confidence is fleeing paper assets and rushing into real money. Let's get back to the interview.
Any surprise that gold and silver are continuing to surge this morning? And to be honest, I could see gold easily at 5,000 by the end of the year. Yes, that's how serious things are. And why do I say that? Well, because even investment banks like Goldman Sachs said that if Trump kept pushing the Fed and kept infringing on its independence, so to speak, that gold could easily go to 5,000. And I think what gold is doing, and silver also, they're telling us that the system is in trouble, that people are rushing to protect. They want something without counterparty risk because the credit market is under pressure. I even said last week when I spoke about this that the ECB is even looking at that. They're concerned. So yeah, gold is forecasting this, I think, that credit markets are in trouble. So people want to have some physical gold and silver outside the system. But it's also forecasting that the QE will have to come out, the bazooka, Jay Powell's bazooka, or you could call it Trump's bazooka now, because it seems like Trump and his administration and the Treasury are more and more in charge of the Federal Reserve. Is that a good or a bad thing? To be honest, I don't care. The ideal situation for me would be no central bank, because in a supposed free market capitalist economy, you don't need a monopoly central bank. Banks that are in trouble, they should fail. Yeah, well, let's look at gold and silver, what they're doing. I said I wouldn't be surprised if gold reaches 5,000 before the end of the year. That might sound outlandish, but it isn't. Back in 1979, gold was trading around 400 in November 79, and by January it traded up almost to 900. So gold more than doubled in a period of 2 months. So for gold to go to 5,000 wouldn't even be doubling. And silver, overnight we traded above 47. So the high's been 47.18. I said on X a few days ago when we broke 44.20, which was the level I was looking at, that there wasn't any resistance now until 48. And I think that's where we're going. I wouldn't be surprised if we go to 50 this week. That will be really interesting. It's interesting to be alive and see silver try to break 50 for the third time in 45 years. And why do I say that? Because I think it could be explosive. And that's what I said in my video on Saturday. I'm going to put it up here in the cards if you haven't watched it yet. What about gold? Well, gold traded up to 38.18. That's the spot price. We're now at 38.12, up over 50 bucks. We've got the NASDAQ up 0.5%. NASDAQ futures, S&P is up about a third. It's trading at 6,668. And as I said, the dollar's a little weaker. The pound's up 0.25%. The euro's up 0.2%. And the dollar is down about 0.5% versus the yen. What about some other currencies here? It's been a while since we look at the other currencies. We got the Aussie dollar up a third. That's not surprising. Aussie dollar doing well here with commodities doing well. Canadian dollar is down slightly, about 0.125%. What about the Kiwi dollar? Let's see, Kiwi dollar is up 0.25%. And WTI crude looks pretty firm. I mean, it's trading around 65. It is down 0.8, but from what I've seen in the last few months, it's been stuck here in the low 60s. So we are in the mid 60s. It's that inflation problem Peter Schiff is talking about. High-grade copper is doing well. That's up 0.2% at 482. And we're seeing a little bit of a rally in treasuries. Maybe it's because of the credit markets being in trouble. People want treasuries, not so much the corporate sector. So the 10-year yield is down 3.5 basis points at 4.15, and the 30-year is down about 4 at 4.72.
Gold and silver are no longer quietly signaling they're shouting. When Wall Street abandons its sacred 60-40 playbook and starts allocating billions into gold, when veteran market watchers openly call for $5,000 gold and $50 silver in a matter of months, it's not speculation, it's confirmation. These moves aren't driven by greed, but by fear. Confidence in bonds is evaporating, stocks are wobbling, and the so-called safety nets of the financial system are fraying. Capital is migrating toward assets with no counterparty risk, the kind that can't be printed, frozen, or defaulted on. Whether gold outruns stocks or silver finally shatters its 45-year ceiling, the direction of travel is unmistakable. The world is quietly repricing real money. If Wall Street is piling into gold and silver for protection, why are everyday investors still sitting in stocks and bonds? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support and enjoy the video.